Welcome to Beyond Four Walls. I'm David Dworkin, President and CEO of the National Housing Conference, the nation's oldest and broadest affordable housing coalition. Here, we'll dig deep into the pressing topics of housing in America. And while we do that, we'll also get to know some of the people who've devoted their lives to seeking tangible, actionable, and achievable solutions. Thanks for joining us. My guest today is Michael Barr, Vice Chair for Supervision at the Federal Reserve Board of Governors, recorded at the National Press Club on November 3, 2023, during our event, Breakfast with Barr, a conversation about housing and the Community Reinvestment Act in the 21st century. Before we start, a little bit about our guest. Prior to joining the Fed, Michael Barr was Dean of the Gerald R. Ford School of Public Policy and founder of the University of Michigan's Center on Finance Law and Policy, as well as a professor at the University of Michigan Law School. Go Blue! He also served as Assistant Secretary for Financial Institutions in the Obama administration, notably from 2009 through 2010. So that was an adventure in and of itself. I hope you'll eventually write a book about that. I'm sure your students already hear plenty. And he held various positions in the Clinton administration, at the Treasury Department, and at the State Department. Mr. Barr has an undergraduate degree and a law degree from Yale University, which, as you know in Ann Arbor, we refer to as the Michigan of the East. So let's talk a little bit about CRA, a law that was passed in 1977. You actually worked on the last major revision of the regulations in 1995. Tell us, why do we need CRA, and why is this particular new regulation so important?
Well, thanks, David. I think the Community Reinvestment Act is really one of the foundational pieces of legislation that Congress passed to deal with redlining and discrimination in housing markets. And it's really designed to help ensure that banks are serving their entire community, including low and moderate income communities. As you mentioned, the last major revision was in 1995, and it's really important that we update the Community Reinvestment Act to make sure it's serving its purpose, that it's actually helping banks to serve all their communities, that it's overcoming redlining and discrimination issues, that it's updated to meet the needs of the current environment that we live in. The banking sector has changed a lot since 1995. There's online banking, there's mobile banking. I think, as you've said, our cell phones in our pockets are our bank branches now.
That's right.
So we really do need to make sure that law stays up to date, and that's what this revision does. So it updates the law to make sure that banks that are using online and mobile platforms that have a national footprint are serving all their communities. It provides greater clarity to banks and communities about what counts under the Community Reinvestment Act, so that the communities can work with banks to find projects that meet their needs of the local community. It provides metrics, so there's greater consistency and transparency about how banks are serving local communities. So these kinds of initiatives in the rule are all designed to provide greater clarity, greater consistency, greater transparency, to update the rules for the environment we live in, and really to make sure that CRA is strong and vital for the next quarter century.
Yeah, I think that's right. There were two things that were the most problematic. One of them is that banks often didn't know what they were getting credit for, and they had to guess. And as you know, when banks are incredibly siloed, and so when somebody's presenting an affordable housing deal or community development compared to a straight market rate deal, they might be getting an 11-point rate of return as the other guy's got 20, and they're competing for that allocation of capital. And if I can't say I'm getting CRA credit for that, I'm a -9. And so how did you do that? How do you increase the ability for community reinvestment officers to be able to say, yeah, I'm going to get credit for this and this is why?
It's a great point. Look, I do think it's important for banks to have that kind of certainty. As you said, CRA officers need to know that this deal is going to count. And it's also important for communities to be able to say, if you're a community member, to be able to come to a bank and say, I've got a deal, it's a qualifying CRA deal, I need your help. And so that kind of clarity is really important. So we do that primarily in two ways. One is there is a set of illustrative eligible activities that are spelled out in detail in the rule. So really for the first time, you can say in the rule itself, here are the activities that count. And then the second thing is we've set up a process. So if a community or a bank has an activity and they're not sure whether it counts or it doesn't count, they can come into the bank regulators and show them the project and say, is this a CRA eligible project? And we have a process that we'll put in place so that examiners will know in advance, banks will know in advance, communities will know in advance, yes, this is a qualified project.
Another area that was particularly problematic, and I think the biggest change in the banking industry, was the fact that, as you mentioned, there was no internet banking in 1995. There was no mobile banking, which is a whole nother level of banking. I don't know when the last time I was in a branch. It's been years. And no offense to banks who actually are continuing to have branches, I think that's going to be a really interesting development over time, is the new branch model and how that evolves. But many of us, our branch isn't made of bricks and mortar, it's made of zeros and ones. What does the rule do to adjust to that reality?
Well, let me say that the CRA rule takes really a kind of both and approach. So for many communities, branches are still an important way that people get access to financial services and loans and deposit products and the like. And so the rule continues to have assessments based initially on where branches are located. But we also recognize, as you said, that branches are not the only way that banks serve communities. And increasingly over time, that may be the case. Increasingly, it may be the case that people get their financial services not in a branch, but through their mobile phone or through the internet or through other ways. So we have facility-based assessment areas, and then we have an approach.
And a facility would be a branch.
A branch,
or
exactly.
an ATM.
Yep, a deposit-taking ATM or a branch. Then we have another approach. It's called retail lending assessment areas. And that's for the areas outside of the branch network where banks that are not predominantly branch-based banks engage in a significant amount of activity. And so those will also be assessed. And then we have kind of a catch-all approach for all the other activities that banks are doing around the country that are not within either the branch areas or these retail lending areas. They get rolled up on a national level to the bank. And importantly, we also explicitly take into account on a national basis all the community development activities that banks are conducting. And that's designed to make sure that we don't have banking deserts on community development activities. So you can really see the opportunity for banks to serve the whole country with their community development engagement.
And that's one of the areas we commented on in our letter during the proposed rule consideration, this fear that community development would be left behind, and that the problem with CRA deserts and CRA hotspots would actually get worse. How did you deal with that? And tell us a little bit about the changes you made to try to fix that.
Well, you know, importantly, community development is measured in lots of different ways. So there's community development investments that get specially called out. There's community development lending. We made sure that we highlighted the importance of the low-income housing tax credit and the new markets tax credit as avenues for investment by banks because those tools are so critical to serving low and moderate income communities. As I mentioned, we have the ability of banks to get credit nationally for their community development activities, both lending and investment. I think that's really important to making sure that you do have some communities where there's a lot of competition for those scarce bank dollars, and other communities that aren't very well served by banks with those community development dollars. And this approach lets those dollars flow to really where they're needed all across the country, in rural communities, in smaller communities, in native lands, and all of that can be better served under this new approach to the rule.
One of the more technical issues, but I think it's important because, when I was at the Treasury Department, I worked under President Obama as well as President Trump. I was a civil servant. And when Secretary Mnuchin came, he was the one who started all this, pretty much, to say, we need to deal with CRA. And people were terrified. It was like, oh, he's going to throw away CRA. But in reality, what he said was, stop trying to guess what I want to do and just tell me how to fix it. Because when I was a banker, I had to buy these mortgage-backed securities every year when we were short. And, at Goldman Sachs, I used to sell them. I was happy to sell them, not as happy to buy them. We need to make this better. In the specific case of mortgage-backed securities, the issue is that, these things can be churned. People will buy them and then resell them. Somebody else will buy them. And you don't really make a difference for something you're getting credit for. How did you address that in the new final rule?
Well, first let me just say, the CRA has always been a bipartisan rule.
Right.
I mean, the Republicans have supported it, Democrats have supported it. It really is a rule that I think has stood the test of time. And this rule, I think, also is going to have really broad-based support really across the country, and I think that's important. With respect to mortgage-backed securities, they do count under the rule, as they have for many years. The rule is targeted at mortgage-backed securities that are primarily affordable mortgage-backed securities. So at least 50% of the mortgages need to be directed to low and moderate income households and communities in order to count. The rule has a provision that says the mortgage loans that are in the mortgage-backed securities need to serve these low and moderate communities, but also the MBS held by the bank can only count for one bank at a time. So they need to be eligible as of December 31st of that year. And also the examiner has the discretion to take into account how long the MBS has been held on the bank books. And in addition to that, the examiners have the discretion to look and see, is this a mortgage-backed security that basically is being churned? And they can use that as a qualitative factor to understand whether it should count or not count under the rule. So mortgage-backed securities count because they serve an important purpose, but it's important that they not be abused in the way that you described.
So now that we've put on our wonk hats, we
Yes.
can take them off briefly. And
I keep mine on all the time.
I guess you do, yeah. I try to go back and forth. The issue of partisanship. And this was something that we stressed in our letter. This was an experience that the OCC had. There was an effort to redo CRA regs. The OCC came up with what I think is fair to say was a pretty partisan approach, since it had a lot of partisan opposition to it. So much so that the Federal Reserve Board of Governors and the FDIC ended up not going along with the OCC. That rule didn't last a year. And now we've got a new rule. You were able to, there are two Republicans on the Federal Reserve Board who voted on this. You got one of them, you didn't get the other. And this notion that...
Well, there are three Republicans on the Federal Reserve Board, and two of them voted.
And you got two. Thank you for correcting me on that. So when you think about this now, we want to have a rule that's going to last.
Yeah.
If there's a change in administration, and there always is eventually, the pendulum doesn't stop swinging, and we want this work to continue and be there 10 years from now.
Yeah.
How did that factor into your thinking? How did that factor into the negotiations? And do you think you got it right?
I think we have a terrific rule. I think that it's a rule that not not everybody loves every piece of it. Any rule involves compromise and involves adjustment. But I think the rule is going to be a really durable rule. I think that the rule that we have put in place will last many, many years. It's designed to be flexible. It's designed to be able to adjust as the financial services sector adjusts. It's a balanced rule. It's a reasonable rule. We heard lots of feedback in the comment process. We took that feedback on board. There were lots of changes between the initial proposal and the final rule. And I think that it's an approach that is going to really stand the test of time. I'm quite confident of that.
So, one of the most partisan elements of it, unfortunately, is race. And I hate the fact that racial equity has become so politically weaponized today. But we had recommended, among many others, that the CRA more directly address racial equity, because the foundation of CRA was to address the legacy of redlining when housing discrimination was not only legal, it was required by the U.S. government for decades. The reg does not address race directly. You do have a reference to special purpose credit programs, which are designed under the Equal Credit Opportunity Act to directly address race. What happened there? Why not go further? And how will the CRA really address race in the future?
Look, David, I think it's fair to say that race has been a central issue in finance for many decades. For a long period of time, as you said, the U.S. government explicitly endorsed that racial discrimination, and many in the private sector practiced racial discrimination. We still have issues with racial discrimination, of course, today. I think it's important to see CRA in the context of the set of laws that Congress passed to deal with this issue. There's the Community Reinvestment Act, the Home Mortgage Disclosure Act, the Fair Housing Act, the Equal Credit Opportunity Act, and all of those acts together are important elements of how we try and push back against racial discrimination in housing and in finance. They're all really critical. With respect to the Community Reinvestment Act, the rule includes several provisions that relate to race directly. One is, of course, the inclusion of special purpose credit programs as qualifying activities under the Community Reinvestment Act. Special purpose credit programs, I think, are really essential ways that banks have developed strategies to help make sure that they're serving their entire community, including minority communities. And so we strongly encourage banks to set up special purpose credit programs. We think they're really good and valuable ways for banks to serve their entire community. And as you said, they're permissible, they're encouraged under the Equal Credit Opportunity Act. The second provision with respect to race has to do with the way that we present data under the Home Mortgage Disclosure Act. Under the rule, Home Mortgage Disclosure Act data will be available to the public on an assessment area by assessment area basis. And so that's an important tool that communities can use, that banks can use to make sure that they're serving their entire communities. Also, if a bank engages in discriminatory or other illegal credit practices, they can be downgraded on their CRA score. Obviously, you wouldn't want to give an outstanding rating, for example, to a bank that was engaged in significant discriminatory practices. That would be illogical. They're not serving their entire community if they're doing that. So that is also included in the rule. And then lastly, of course, you don't want banks to draw the lines about their assessment areas in a way that exclude minority communities. That would be wrong, and it's not permissible under the rule.
So when NHC first engaged in this, we came up with 4 principles that we felt were critical to successfully doing CRA reform. It had to improve the CRA implementation for low and moderate income communities. It had to improve it for low and moderate income people. It had to ensure that any changes were not going to result in displacement, and that it was going to be better clarification and predictability around the reg. We've talked about most of that, but in terms of displacement, one of the key strategies in ensuring that people in communities that are getting more and new investment is the low-income housing tax credit, which is going to create units in that community that are tied to low and moderate income. When we talk about low and moderate income, what we're really talking about are the people who make our coffee every day, or work in our restaurants, who service our cars. I mean, there's a lot of people in that category who we interact with every single day. Many of them can't afford to live in these communities. Tell me a little bit about how you dealt with the low-income housing tax credit. There were a lot of concerns about that. What do we deal with in terms of that?
Well, first let me just say, I think the low-income housing tax credit is a really critical tool for affordable housing in low and moderate income communities. It has been for many years. It's really an essential strategy, and banks are obviously important participants in that marketplace. So the CRA rule especially calls out the low-income housing tax credit as a responsive strategy for banks to use. It gives an impact assessment for using the low-income housing tax credit. And we expect that the Community Reinvestment Act attention that we pay to the low-income housing tax credit will make sure that banks stay active participants in that market going forward.
And that also segues into implementation. The implementation period is going to be long, 2 years. It's a very complicated regulation. I think it's almost 1,600 pages. We have the opportunity to comment and elucidate elements of the implementation through the Q&A process and regulatory guidance. Frankly, I just want to be clear that I'm hopeful that we can push that line further into dealing with racial equity through that implementation process. I think it's critically important. But we're going to actually get a chance to comment and improve on all kinds of elements of this within the 4 corners of the rule. Tell us a little bit about what we should expect in the implementation process.
Well, David, let me just say, I think that the final rule that we put out is really important, but the implementation is also really important. We set out a 2-year period for implementation to make sure that not just banks, but communities and regulators were all ready for the new approach. And I think that that's important that we have that time period. We're going to use that period to really continue the outreach that we engaged in when we were developing the rule. Outreach to the financial sector, outreach to communities, outreach to civil rights groups. I really view implementation as a partnership. It's not just about what we do, it's not just about what banks do, it's not just what about communities do, but what we do together to make sure that the rule is effective going forward. We're going to be developing tools, online tools for banks, online tools for communities, online tools for us as regulators. And we want to make sure those tools are effective and that they work and that they're giving banks and communities what they need in order to do their jobs, in order to be effective. So we want input on that. We want a real partnership on that. We're going to be engaged in examiner procedural manuals. We need a whole set of examiner procedures to make sure that examiners know how to implement this new rule. And again, we're going to get input on doing that. We're going to be doing examiner training. We're going to be doing training on things like how do you make sure that communities stay engaged in the CRA evaluation process. Community input is so critical to making sure that examiners and banks know what the community needs are and whether they're being served. So we want to make sure that community input stays a really critical part of the Community Reinvestment Act. We have these metrics we're using in the rule, but metrics have to be matched with real meaningful community engagement so that we're sure that banks are really doing the qualitative work to make sure that they're meeting the needs of their community. So all of these initiatives on implementation are really critical. As you said, we have a good bit of time. We have 2 years to get it right. But to get it right, we're going to stay engaged with all the communities and banks that are involved in this process.
We have a live audience here. We have hundreds of people online. There'll be many more watching later on C-SPAN. We have some questions from the audience.
Great.
Since we're here at the National Press Club, we're going to use Press Club format, and people have written out their questions, and we can take a look at those. All right, great. Thank you. So you talked about the training of examiners. How much does examiner discretion play into the scores that banks get in terms of that determine their ratings?
Well, let me say, at the first level, I think the rule makes significant progress in improving consistency and improving transparency by having clear metrics that banks need to meet in order to demonstrate that they're serving their entire communities. And I think those metrics are really important. At the same time, we do need to have qualitative judgments about the way in which banks are meeting the needs of their communities. And that qualitative judgment involves input from community members, from civil rights organizations, from community groups, from neighborhood organizations. So that input is really critical. And we do need examiners to use their good judgment to understand whether the activities that are going on are actually meeting the needs of communities or not, the qualitative ways that banks are serving their communities. You've been in this business a long time. Some deals may not be large in number terms, but are super innovative and difficult to pull off. And we want to make sure that banks are getting credit for innovative work, for the qualitative work that they do, in addition to this metric-based approach.
And that is really a great segue into our next question, which is about CDFIs, Community Development Financial Institutions. You were very involved in that, your first run at Treasury. I worked for the CDFI fund when I reported to you a couple levels down from that. And but tell me about CDFIs. How does the new rule impact CDFIs differently than it did before?
Well, look, David, I think, first of all, let me just say, community development financial institutions are really, really critical in serving low and moderate income communities around the country and in demonstrating innovative ways to serve their communities that then can be replicated by other financial institutions. And that's also true of minority depository institutions. MDIs, minority depository institutions, have a special role in serving minority customers around the country in ways that non-MDI institutions can learn a great deal from. And so MDIs and CDFIs and women-owned institutions, community development credit unions, these institutions are really highlighted and called out in the rule. And in the rule, banks are given special consideration for using those institutions, for partnering with them to serve low and moderate income communities. So I think the rule will give special impetus to these kinds of partnerships between banks and MDIs and CDFIs around the country.
That's great. And last question, let's skip ahead 2 years. I'm a community development officer. I've got an investment. I'm not sure if it's going to qualify. I want to go to my examiner and ask for pre-approval. One of the problems we've had in the past is one, we may get an opaque answer. The other is that we may not get an answer in time for it to make a difference. So tell me about that pre-approval process and how we're going to ensure that the guidance you say we're going to get is going to come in time for us to actually invest in the deal.
Well, as I mentioned, one of the reasons for this 2-year transition period is not only for banks and communities to have time to get ready, but also for regulators to have time to get ready. So we're going to put in place a system that works, that's responsive, that's timely, that is unified across the agencies, that is transparent and public. And that's a way to make sure that communities and banks get clear answers, they get timely answers, and that those answers can then be used by others who are in need of clarity on these issues. So I'm confident we'll get there, but we do need to invest in the resources to make sure that we do that right.
And that's going to be something we're going to continue to look at and communicate with you about. I want to thank you so much for being here. This conversation will be on nhc.org later, and so for those of you who want to share it or who missed it, if you missed it, you probably didn't hear that plug just now, but that's a separate issue. And we look forward to working with you on a wide range of issues. I know we'll be talking about capital rules soon. You're in a comment period on that. And always interested in talking about interest rates. The Federal Reserve Board, I think, affects most Americans in ways they never can even imagine. So thank you for your service. Thank you for being here. And thank you for giving us a new CRA for the 21st century.
My pleasure.
Thank you for listening to this edition of Beyond Four Walls. You can visit the National Housing Conference at nhc.org. There you can learn more about affordable housing policies, affordability challenges throughout the nation on our Paycheck to Paycheck database, and explore membership in NHC for you or your organization. We appreciate your interest and look forward to working with you in the future. Until next time, I'm David Dworkin, NHC's President and CEO, wishing you a great day.